Well. Welcome back, everybody, to another fantastic episode of the Explain It podcast. We are your hosts. I'm Stephen Hunt.
And I'm Ingryd Hernandez.
It feels like it's been a century since we've been on here. I know we only missed 1 week, but for whatever reason, it feels like, gosh, I feel almost a little bit rusty. What about you?
100%. I was like,
how do you podcast?
Especially because we actually took a break. We actually took time being with our families and enjoying some Thanksgiving eating. And I was like, wait, we didn't have a meeting last week. He's like, Steven was like, yes, we did. We did have a rehab alignment meeting. I was like, wait, what?
It's almost like last week didn't happen. Yeah. But I mean, ultimately, I feel like that's how business works. When it's the week of Thanksgiving, I'm like, okay, some people get Wednesday, Thursday, Friday off, and people just carry that over until who knows when.
Yeah.
So regardless, we have an awesome guest for you guys today. We're so excited about this, talking all things whole life policies. Ingryd and I are both huge advocates of the infinite banking concept. So we are so pumped to bring this to you guys. So without further ado, please welcome our guest, David Foxx. David,
how you doing?
Thank you for joining us.
Absolutely. Thank you for having me.
Oh, absolutely. We're so pumped to get this started. So just to give the audience a little bit of background, who is David Foxx? Give us your story, and then we can start breaking into it.
Perfect. Well, I started my financial endeavor more than 20 years ago. And so 2 decades ago is really where I started getting into the financial industry and learning what the capabilities are. And really dove in and started doing this because of how my family situation was. I saw this guy come into our house. He's carrying this briefcase. He's like, hey, let me help you financially. So he set up all of these accounts for my parents. And a few of them that actually stuck out was the reason why I went straight in. And one of those is what's called infinite banking. So that's kind of what I do it today. We have clients across the U.S. Just last week, we actually started doing business in Canada. We'll have Mexico in January. So there's a lot that's really kind of going on right now. So we're pretty excited to be going into other places. But this concept is not really new, but it is new to a lot of people. So a lot of what we do is education. So that's why we really dive in, and we're hoping to share some with your followers today.
Oh, that's fantastic. Yeah, I'm a huge advocate for the infinite banking concept. It's something that it's one of the first things I actually did before I even bought my first real estate deal. I went ahead and started this whole process because I was like, well, just in the worst case scenario, if I never got a real estate deal, we can talk about strategies and all that kind of stuff. I'm like, I at least want this. After I interviewed 5, 6, 7 people, whatever it was back then, it's like 4 years ago. I was like, well, clearly this is the route to go. Clearly this is what we should be doing. So I'm really pumped to start breaking that down. So what is infinite banking?
That's a great question. Good place to start, right? So infinite banking is really when you first mentioned what we were kind of talking about today, using whole life, that's usually where we lose everybody. Right. Mm-hmm. So both of the listeners that I speak to, half of them are gone. Right. So, but this concept has really been around for centuries. Right. It's been around for a long time, and using and being able to leverage a dollar to be able to have it work in multiple places is really what we're talking about. Right. So it's, a guy that framed a book called Infinite Banking or Becoming Your Own Bank, or IBC. He called it removing the stinking thinking that we have. Most people are just so used to, hey, I've got this lump of money, I'm going to put it inside an account and just kind of leave it there until I need to use it, right? Until I need to put it inside some investment or hopefully get it to grow, right? But when we do that, we're basically giving banks the cheapest loan that's ever been invented in history, right? They're giving us 0.06%, which is the national average, on the money that we give them to use. And what are they doing with it right away? They're leveraging it. So instead of allowing them to gain all of the access and all the power of that money, we're showing individuals where they're placing their money so they can do the same thing. So that's kind of the snap of what infinite banking is as a whole. But it's really the design to make sure that you're being able to leverage your dollar and being able to place it in a vehicle that will continue to have it liquid for you, so that you can use it when that investment comes along, or that a property comes along, or larger purchase. So you don't have to actually go to a bank to receive a loan. Right? You want to be able to have that money available to you, but it's still growing at a much higher interest rate to still be guaranteed for you.
Mm.
Yeah. I like to just think of it as doubling up your money
at
minimum, or
Right.
at least, And this is why I went and got the domain secureyourmoneyfirst.com. You're securing it. I have a story with somebody who was into infinite banking, and thank God he was, because he lent $100,000 to someone, but he first took it out of his policy to lend out. His policy was charging him, I think, 4 or 5% for taking that money out, but he was going to go and make 15% to lend it. But when he did that, he had wire fraud. Somebody took that money from him. So imagine if that had come straight from his bank account, it would be completely gone.
Yep.
It would be totally out. And so it's why I went and grabbed the domain. Secure your money first. Like, go put it into an insurance policy and then lend out, because you want to make sure that you're, to your point, fully leveraging that opportunity.
And you guys, one thing that I do want to point out is it can be considered a higher level concept as well. To fully understand this, to grasp this, you probably need some form of financial background, education, knowledge to understand this all. So don't hesitate to ask questions. Ask all the questions. And rewind this and reach out to us all personally as well. Reach out to David, reach out to me, reach out to Ingryd, and ask additional follow-up questions if we're not getting to absolutely everything. But that is a huge piece of the whole life policy that I absolutely love. And maybe you can break that down a little bit more, David, is the protection. The protection of that money is something that I don't think gets focused on enough. People see the benefits of, doubling down on the money. I'm making interest here. I'm making interest there. I have all these uses I can use for it. The strategy, the exciting stuff that people love, but people don't talk often enough about the protection of that money as well, which I think is huge.
Right. Exactly. And Stephen, Ingryd, I think you guys are like reading off my notes, because like I even have that in here. Make sure we're covering the protection asset of this asset. Right. And many times people don't understand why Ray Kroc or why Disney or why, larger corporations are doing this already. And even how much of banks are typically putting inside policies like these so they can take the money out. Because imagine like you put 100,000 inside a bank and you come back a couple of days later and they say, you know what, the market was really kind of crazy. We lost about 10% of your money. You probably would never go back to the bank. Right. That would be it. So they cannot put your money at risk. They always have to have it guaranteed for you to be able to come out and get that. So they are only able to put it inside secured vehicles. So why are they using life insurance? Life insurance has specific tax codes that are allowing it to grow tax-free. You can distribute it or take it out tax-free. And if your beneficiaries or when you pass away, your beneficiaries will receive the money tax-free. Right. So that money that's in there is secured from volatility. It's not actually inside the market. Right. It's not inside an asset that's actually having a variable cost to it. Right. It is a part of a life insurance policy. So here's what typically happens to your money. When you're putting money inside of it, a portion of that goes to the cost of the policy. A larger portion of that actually goes toward a compounding growth, whether it's in a whole life policy or it's in an IUL policy, whichever someone uses, because both are kind of popular today. But now this amount will continuously be making funds from a guaranteed stream. So there's usually, if you're doing a whole life policy, it's a guaranteed stream of about 3.5%. And then since we're using a mutually held company, which means a company that's owned by those that are owning the policies, it's also paying dividends. So we are only using those companies that are paying those dividends that completely have a great track record, right? The track record is important because not only is it guaranteed from having ever any loss, but now we want to have a continuously predictable growth that's in it. So when we leverage the money out of it, we already know we're leveraging against loss. We have individuals that actually take money out to put into crypto. So it'll be like, hey, I hope this money grows. I'm not sure. Like they're a lot better at that than I am. I like to use it for hard money lending. I use it for real estate too. I own multiple policies. The reason I love using it for hard lending is because, like Ingryd was mentioning before, I'm taking that money out of my policy and I'm giving it to someone else to finish a job, right? Finish a project or do a flip. I'm charging about 10 to 15% on that loan. But while it's there, I'm still accessing the growth inside my policy. I know no matter what happens, this money out here, and if it gets lost for a little while, I can't use it. I got to make sure it's coming back. And then I'm also being able to grow it in my policy so that I've got it working in two different places. So I know that we kind of went off on a tangent there, but the security of the money was really important for me and also most of the investors that I work with, because they want to make sure it's always there when they want to use it for the next project.
Oh, absolutely. And I love the idea that it continues to grow tax-free even while you're using the money. And we can break that down a little bit more too. So from a real estate investor perspective, like myself, I own a portfolio of rental properties. If I have somebody, and I'm curious to hear your thoughts on this too, because this is what was one of the reasons that it attracted to me, was if I have a property and let's say I had some shoddy work done at that property and my tenant electrocutes themselves and unfortunately they die. And now that family and everybody's coming after me. They seize all my assets. They take me down. From my understanding, it sounds like that policy is essentially untouched. Is that accurate?
That is correct. One of the great attributes of using a life policy is because it has protections from what I call predators, right? So those that really want to get their hands on potential money that's there, but since it's an individually written policy on an individual, they can't actually go after a life policy. Right, even secure from divorce, so those individuals that are out there, kind of thinking it, I might as well put it out there anyway. So the security of that, like, for example, we can use O.J. Simpson as an example, right? So after he ended up getting through his court troubles, they actually tried to take him to civil court and sue him for more additional funds. And he had $43 million inside his whole life policy that they couldn't go after.
Wow.
Right? So because it's an individual that's actually being insured, so you can't divide a person.
That is awesome.
Yep. Did you guys hear the O.J. Simpson thing that recently came out?
No, there's always something coming out. I feel
this is true. Literally, it was yesterday, though.
Oh.
There was a headline that came out that supposedly on a thumb drive somewhere, there was information where O.J. confessed. I don't know if it's true. That's the headline I read yesterday. So it's funny that you brought him up. Yeah.
Can't get him now.
Okay. So I have a question from Instagram and I don't want to accidentally forget to ask it.
Mm-hmm.
So Maritza, and forgive me guys, I'm not on here like not paying attention.
She's answering emails. She does this all the time. No. It's like, I'm like, can we just, I'm joking.
No. I'm trying to make sure that you guys out there, especially on Instagram, come over to YouTube. But Wolfie the Kid was asking, is this only for people who lend out money? The answer is no. It's just such a great utility of a specific policy that it can go beyond just insuring your life. And it's because it's a whole life insurance, that means you're not renting your insurance like you are with term life. You literally get it for your whole life. So, but yeah, you don't have to lend that money. It's just really a great benefit to you if you're somebody in that space.
In fact, what a lot of people actually do with whole life policies that I've spoke with is that they'll actually purchase their expenses where they would typically. So for example, I'm in the process right now where I have to go get a new car. My lease is coming up. I don't want to lease another car. So I'm like, well, maybe I'll just purchase a new car, and I'm entertaining the idea of getting a Denali, but I probably won't because I'm responsible and that wouldn't be the right move. However, I've definitely fantasized it, and it's because my interest rate going through the whole life policy is going to be less expensive than me actually going and getting a loan from the bank. Don't have to qualify through the bank, and then I'm making all the payments back to myself. I would actually just try to match whatever my payments would be. And that way I'm just paying it back to the policy. And that way, let's say I go buy this $70,000 car. That $70,000 that I'm using is continuing to grow in the meantime while I'm paying it down. So by the end, I've paid back my policy, and now I have this car that I could technically go sell on the market and sell it for probably $50,000 at the end of 4 years.
Yeah, Johnny said get the Denali. That's funny. So definitely, to kind of address both of those, if we actually look at a case study, right? So because many people are like, hey, tell me where can I look to see some of this stuff in action? If you remember a company called Gerber, right? A baby food company, right? Gerber no longer is just in baby food. They're actually in, baby assisting foods so college planning, right? They're helping babies actually get college planning by using whole life policies. The Rockefellers, they actually became popular today because of what they're doing inside their trusts. They're actually opening up whole life policies on every new child that comes in. So as long as they're 14 days or older, they're able to open a new policy, and a grandmother's just sticking small amounts in. It could be $50, $100, $250, whatever it is, right? So as that money just continuously compounds and grows, it can now be used for any purpose. It can be used through college funds, or maybe that individual wants to be an entrepreneur and open their own business. We have individuals now, like a trucking company we just finished with. out of here in California, they're actually using it to purchase new vehicles. So instead of going and doing all of these loans from banks and seeing all their money disappear in interest rates, they're actually using their own bank through a whole life policy, taking the money out, paying themselves back, and then doing the same thing over and washing it as many times as they can. So a lot of different examples of how they're actually used today. The thing is, like we talked about before, most of it is more of like just stinking thinking. Like just because we've never heard of it before, or the banks don't tell you about it, or your financial advisor is not running you through the numbers, is because this is something that you own. A financial advisor can't charge you for this. It's not money under management. This is simply something that you own with an account, an agreement with a mutually held whole life policy. So go ahead, Stephen.
Oh, I was going to say, that's actually funny that you bring that up, because I talked to several financial advisors, if you will, that have had 30, 40 plus years experience doing this kind of stuff, run their own companies, all that kind of good stuff. And I was like, what do you really think about this? And they all hated it. They all hated it. And I was like, not going to listen to you guys. I'm like, this makes sense to me. And I put it into action and started using it. And I was like, this still makes sense. This is a fantastic tool. I love using this.
I actually love that you just brought that up, because Jackson Miller on YouTube was asking, would there ever be a reason why someone should not get into infinite banking? And other than they're maybe too old to go get a policy, which, by the way, there's a workaround with that. There's generally a workaround with all kinds of things, but we'll cover the workaround. But first, let's answer the question. Is there anyone that shouldn't get into infinite banking?
Definitely. You know, if there's someone that's actually in a position to where maybe their health concern is deteriorating, like maybe they've gone through cancer, or maybe they've had multiple heart attacks, or they've had they've got some major concerns that they're dealing with now, it may not be beneficial for them to have an infinite banking policy, because the cost of the policy would overtake the benefits. Right. So that's why it's important to structure the policy and making sure that we're sitting with that person to get all of the details before we even go through the qualification process. Now, if that happens, like you were mentioning, Ingryd, there's so many different ways of getting around that, because there are three parties to any given policy. Right. There's the owner of the policy, there's the insured of the policy, and there's the beneficiary. Right. If those individuals don't have to always be the same. Like, for example, the owner could be a parent of a child. So the owner is the one that's pumping all of the money into it, but the child is actually the one that was the insured. So you're using that child's great health to have this great policy with you that's now the cheapest available. And
let me borrow Olivia. Sorry, I'm just kidding. Sorry.
Exactly. So that is one way. Another way is it is an extremely beneficial tool to use as a wealth transfer vehicle. So last week, we just completed a policy on someone who was 67 years old. So it really just depends on the situation, right? This individual is getting very close to the maximum amount that they can send out, which is 13.4 million right now on the estate planning. So anything above that, you're paying taxes on, unless it's inside an insurance policy. So instead, you can start purchasing policies on all of your children that you want to leave as beneficiaries. And now you're putting money in there going way above the gift tax or limit that you have. So you can put whatever you want to up to the certain amount that they're insured for. So that's the best way to actually transfer it and even have it owned by a trust. You're adding another level to it.
I love it.
It's beautiful. So let's break this down for everybody so that they can fully kind of grasp the picture of what this even looks like too, right? Because we are talking about the concepts of it. We're talking about some of the utilization of it. We're talking about the protection of it. So, and I'll do my best to describe this, and I'd love for you to correct me and fix what I'm saying here. But the way that I view it is, if I go and get a whole life policy, so the first one that we did was with my wife. So that way, if my wife ever passed away, I get a payout of roughly $2 million, we say, right when we started off. And then we were able to contribute roughly $50,000 a year to that policy. And that's what we've been doing every single year, is contributing $50,000. That money goes into the account, and I just let it sit there until the right opportunity comes up, and it's gaining interest in the meantime. So the way that my policy is structured, because I go through a mutual company, like you mentioned as well, I do have a dividend. They've never not made a dividend payment in their history. And I love that you brought that up too, because I see a lot of people going back and forth with different companies. And I always say, you have to look at a mutual company. Have to look at a mutual company. This is what everybody else told me, by the way. I'm just regurgitating information.
No, exactly.
So went to the mutual company, started putting money into that. And then when the right opportunity came up, so for example, we had a duplex that came up, we borrowed against the policy. We took out $40,000 was our entry into that deal. And then that property now cash flows. It actually is a great cash flowing property. It's about a 35% cash on cash return because that one makes $1,100 a month. And then in the meantime, I am getting roughly 6% uninterrupted compound interest on the actual policy itself, on that money that I brought out. And all that money that I make from the $1,100 a month is going to go directly back into that policy.
Absolutely. And this is something I want people to really get out of that conversation. So those of you who just heard that, you're like, okay, wait, start over. Like, where do you go first? First, you want to get qualified for one of these policies. And that's something that actually Ingryd's got a link on that will be able to help you to do that. But the second is like you decide how much you want to start putting into this bank, right? And you can actually take this money as soon as possible. If you need to use it, you can take it out as early as 30 days. That's not typically something you can do in more of an IUL setting or an indexed universal life setting. So typically for real estate investors or investors who are looking to flip money quickly, we go the whole life route. Because definitely having that dividend that's paid out every year on companies, because there's some that we work with that have a run rate of over 150 years of paying a dividend. Like that's pretty amazing, right? Especially if you have a guaranteed rate already. But using that OPM, because when you're moving that money out of the policy, you're not actually taking the money that you put in. That money is still there growing. Like you mentioned before, you're now actually using the insurance company's money to be able to invest in to have it grow. So now you've got two assets instead of one. For businesses, this is called a split dollar agreement or an executive bonus structure. And maybe that's a different podcast, right? But on the infinite banking portion, this allows you to leverage your dollar instead of allowing another place like a bank or a CD or mutual fund, because you can't. As soon as you remove the funds from those, you've stopped the compounding growth altogether. This is the only vehicle that allows you to continue the growth as you're using that dollar outside of the policy. So.
I think the hard part for a lot of people, and this was a hard thing for me to overcome, was the year that I went and got a policy and what I couldn't wrap my head around. And now it makes sense. This is an and product. It's not an or product when it comes to investing. This is just something that you plug into what you're already doing. You add one extra step to what you're already doing, and it's awesome. A lot of people, I think, get caught up the way that I got caught up, where I was up 121% in the stock market the year that I signed up for this. And I go, why the heck would I go get 6% over here and put this money over here when I'm getting 121% return on this side of it? And I couldn't really connect the dots that, oh, this is still growing. I could technically use that money to go get the 121% return while this is still growing. Yes. So I could go double my money plus while all my money is still here.
Yes, and we haven't even talked about the other benefits. Of course, there's the benefits of life insurance, those that now have living benefits. So if you have a chronic, a critical, or terminal illness, or even if you're confined to a retirement account, or maybe you go to a long-term care facility, that long-term care facility now has the ability to go after all of your investments. So they're going to recoup the cost of you actually going to that home. If you actually properly set up this account is going to pay that. And they're not going to touch any of your investments that are still growing 112%, inside the market.
That was a one-off year. That was 2020. Everything was up.
Exactly.
I thought I was an expert.
Definitely. So there are the intrinsic values of just having and owning a life insurance policy, something that is portable, that you take it with you. It doesn't matter who you're working with or where you're going. But it's just the simple, small step of where you're placing your money before you're investing it that makes the world of difference. Don't use Bank of America. Don't use Wells Fargo. Don't use Chase. Don't use these banks because they're the ones that leverage it before you get your hands on it. Even if you want to put it in there and then put it in your bank, that's up to you. But if I were you, I would definitely put it in an appreciating asset, either a home or a large purchase, because now we've had individuals use it for debt consolidation. Imagine this. Today, we have individuals spending like variable rates of like 25 to 30% on credit cards.
Yeah.
If you're moving money at a 4% rate to pay off a 25 or a 30%, how much did you save? It's like you're saving a ridiculous amount of money that now you can use to put back into your policy to have it so you can put into investments.
Yeah, totally. Okay, so we have a few questions. I want to make sure we get to them. And for the record, guys, we're going to have David Foxx back a few times because this is like, what's the opposite of Pandora's box? Because is it like, what's whatever the opposite of Pandora's box is what this is, because there's the level of utility is beyond, and even the types of insurance policies you get are beyond. We're only going to focus on whole life insurances right now, but I remember sitting with your colleagues Randy and Johnny, and I was like, whole life policy, and then they started talking about like, well, it really is a configuration against the person's goals. So I'll give you an example. If you're someone who it doesn't get a lot of opportunities to go and invest, or you don't feel very strong about your skills to go out and get those opportunities, maybe you don't need a whole life insurance that you can go and pull out within 30 days. Maybe you need something that can grow for the next 2 years at a different rate while you then figure out how you lend, how you do real estate, and then feel good about your skills before you take money out. And so when Johnny, Randy, David were teaching me all of this, they're like, everybody goes to whole life insurance right away, but an IUL might actually work out better for somebody who doesn't have that immediate need right now because they're just not at that level yet. And I was like, oh, so there were so many different levers that can get pulled in the insurance world. And once they opened up my brain to that, I was like, oh, I have to be on your team. Like literally, I sat with Johnny and Randy on a Friday, and I even called Steven right after this. I said, Steven, I think I'm going to go get my license. That next week, Tuesday, I signed up for the classes. I started classes Wednesday, Thursday. I had my license 1 week later, Friday.
Yep.
Literally.
It was like that fast.
It was such a fast.
By the way, I'm a good test taker. So
I know it's so crazy. Even the states have reduced the requirements because they need way more people like us, because there's just not enough to handle this transfer of wealth that's happening currently. Everyone needs to be able to place and leverage money. They're keeping their heads down in their own work and their own positions, just like I was, right? Not really knowing what was moving around me, but finally learning concepts like these. I saw a question coming up earlier, about your grandchildren. I wanted to make sure I mentioned that. So you as a grandmother can actually own policies on your grandchildren. It's actually one of the best gifts that you can give them because this will be compounding and growing long after we are no longer here. So I currently have policies also just like that. The only caveat of that is that the parent would also just have to be able to sign off on it that, yes, I'm allowing the grandmother to have. So what normally happens is the grandmother will own the policy and be the payer for the individual who's being the grandchild that's being covered. And the beneficiary will either be the parents or the trust of where that money is going to be going to benefit that child. So it's pretty amazing. Sometimes companies will require that the parents also have life insurance on that spec, and it could be something very inexpensive, like even a term policy, or like if you own a home or any kind of asset and you have children, you definitely need to have something. Yeah. Right? So I'm kind of in that industry, and I know that, you guys aren't, but I got to put my 2 minutes out there. Like if you have liabilities that you're responsible for today, they are still going to exist when you're not here. So you might as well take care of them and making sure you're creating a legacy instead of a liability.
So Olivia's list for Santa Claus is going to look a little different this year, especially if you give it to grandma and grandpas.
Oh, yeah.
Yeah.
Oh, yeah. Guys, go ahead and get one of these.
A whole life insurance and that new Barbie.
Name you as the beneficiary.
Yeah.
Great follow-up question. Can the trust be the beneficiary? I almost prefer it to be. Now, there are some that would rather be a direct person. But if it's inside a trust, it's much more protected, and you have the ability to say what happens inside that trust. Like the Rockefellers have really designed a perfect situation to where the trust itself is the beneficiary of all the policies that are purchased on the grandkids. So they can use those policies and borrow from them. Let's say that Jane wants to have a really large wedding. Let's say that John wants to be an entrepreneur. Let's say that Sean wants to travel the world. So they all have different wants. They can start borrowing from their individual policies so they're not hurting each other. But later on in life, once individuals start passing away, that trust is now refunded. So it's purchasing all brand new policies on every child that comes into the family. So it continues for generations through life.
Yeah.
So very powerful.
Okay. So Marissa brought this up when you specifically mentioned, every year putting $50,000
About
away.
$50,000. Yeah.
Yeah. Could you explain this a little, David? You're the one with the seasoned license.
Yeah, absolutely. So how do you get 50,000 out? She's kind of structuring the questions. I don't know if she's asking where you come up with 50 grand to put into it per year, because it doesn't. Yeah,
he's rolling.
Exactly. It doesn't have to be that large, right? You can end up starting a policy like we mentioned before, just a small one on a grandchild, right? So to be able to take money out of it, even that first year or up to 30 days, you would have to put in probably like 60,000 or maybe 65,000, and then you could pull it out 30 days later. You could pull out the 50. So they give you access about 90% of the cash value that's there, even included within the first 30 days. The reason they say 30 days is because there is a process. So you have to put the paperwork in. They have to verify your account to know where it's going, and then they send it over. But hopefully that's what the question you have. But other than that, he's doing really well, and he just has decided to put his money into there. I have an account specifically that helped my wife and I actually get out of debt when we first got married, and we just kept it. So every time that we see a card just kind of coming up and we're paying interest on it, we just remove it from that, and then that's got funds that are just there for emergencies. It's always really good to have an emergency fund kind of account like that you have access to whenever you need it.
Yeah.
Love it.
Kirk asked a good question on Instagram, and I do want to take a pause for a moment. If you guys are getting value from this, please hit that like button, hit the subscribe, whether you're on Steven's YouTube, my YouTube. This is the kind of stuff that really gets us going. And so this is so exciting to see how many of you are interacting. So please continue to ask your questions. Our good friend Kirk Anderson, who's a really great guy, we're about to list one of his properties. He's just finishing up a flip out in Mesa. He asked, I have a daughter with special needs that will be needing assistance her whole life. What's the best long-term vehicle for something like that?
Great. Kirk, I'm glad that you asked this. And this actually is a personal story of mine. I promise this will be very short. But I have a larger family. I've got 3 older sisters. My oldest sister is a special needs sister, and she has a son, which is a special needs son. And so my parents saw this happening already, and they understood that she's going to need care for the rest of her life and the rest of her child's life. So how do we make sure that this is a vehicle that we use and we can create wealth and continue this, for that person's entire life, even after they were gone? So one is that you need to establish a trust that is a special needs trust, right? The special needs trust gives you certain attributes that you're going to need throughout the entire process, depending on what the age is of your daughter. Right. So as far as the life policy goes, it may not make sense to have the coverage on her, but we have covered those with special needs. It doesn't mean it's a knockout right away. But that special needs trust is now funded with life insurance, both from my parents, but also now from siblings, as well as, her husband and herself. So once they end up passing away, all of the money actually goes into the special needs trusts, which does establish those beneficiaries that are watching over, or the deeds to that trust, that make sure all of that money is earmarked to a care facility for the special needs daughter or son. So important to realize. Now, it might make sense to cover a whole life policy on her as well, so that if she continues to have other health issues like living benefits, she can receive money from her policy as well as through the trust. So we can look up that as a one-on-one. We just need a little bit more information on the special needs and where they are on the spectrum.
I love it.
That's so good.
Really, pop your question, because there's always an answer. One of the things that rocked my world with this infinite banking, I started learning about infinite banking and velocity banking, which are two different things. Before I started learning about creative finance.
Really?
And I almost feel like it was like the again, I need something different than Pandora's box.
Yeah.
It was like the thing that started opening my brain to like
just the rabbit hole.
Wait, yes, the rabbit hole of thinking about things in ways that we've never been taught. Which, by the way, some folks on the comments were like, "You guys need to have a master class about all things in like insurance and infinite banking." I'm like, maybe we will.
There's so much out there, especially like business policies. A lot of your listeners are probably business owners or even have LLCs or structured as S corps or C corps. Like, why are they not taking advantages of those tax codes that allow you to pull money from your company and not pay taxes on that money? It's just like Mark Zuckerberg is doing. He pays himself a nominal tax or salary, and he's loaning himself millions of dollars out of his split agreement. So there's so much that's available just through insurance. And the reason why people don't hear enough about it is because there's no continual payment that you're paying like an agent to set this up for you. For example, usually I've even made accounts where I've lost money on some of these, on how we have to actually go to bat for people to try to set up the right policy and get it to play. These are not high commission payouts. That's some of the questions that I'll get a lot. Oh, you talk about infinite banking because it's a super high commission. I promise you, if you do Google work, you'll realize that this is one of the least, commissioned, style, because you're taking money away from the insurance company right away. Why are they going to pay an agent, a top dollar for setting up something like that?
Right.
So I've always got into this business. My father said, hey, if you just do the right thing for everyone that you're in front of, like they'll send you more people. And that's really what this is about. If we can just continuously help people and show them how to maximize their plans, they typically tell their friends, and then look where we are now. We're in podcasts, streaming live over different social media and really opening up the minds of individuals who have never heard of concepts like these.
Totally. So amen to that, David. And it's one reason why I partnered up with you. I think the values that GFI, the company that I moved to, like that, most of the decisions that I make, whether it's like partnerships or anything like that, I always look at what is the company culture and what are the values, because I really do think that if you don't chase the mighty dollar, rather you chase the problems that you can help solve for individuals, the money will come. Like that's not the epicenter of decision making. So I love it. Jackson Miller is asking, how do you go about vetting a company to get a policy with?
Yeah, great question. A couple of things that you want to look at right away is how they're ranked, right? Standard & Poor's actually does a rating for insurance providers and financial companies. So you want to make sure they're an A-rated company. And also equally as important, if you're doing whole life, the mutually held company is really where the magic happens. Right? Even if you're going to a different company and they're promising a higher rate, like having dividends come to you every year that you have that policy for the rest of your life is irreplaceable. So those would be one of the top two, but typically we focus on the top five that are in circulation now that are the largest, which means, so insurance companies are a little different. They're not like banks. So banks only have to keep $1 for every 10 that you put in. Right? Insurance companies are completely the opposite. They have to have $10 for every one that they've promised out. Right? So they also have a backup agreement. So if you remember, like in the mortgage and loan industry, back in 2008, when the market was going sideways, or actually I wouldn't even sideways, it was going upside down completely. Yeah. There was a company called Countrywide. Right? So I had a property with Countrywide, and everybody remembers, well, they filed for bankruptcy. They were out. Right? To my surprise, I didn't get to keep my house for free. Right. So I still had to give that money to someone. So what happened was Wells Fargo came in and they purchased all of the assets, which actually was a giant move for Wells Fargo, because now they actually assumed all of these assets of properties and are now, accepting mortgages from those individuals. Right. So that's the same thing that has to happen for insurance companies. They have to have an out. If you remember AIG, that was purchased by Voya. Right. This was maybe 6 years ago. And they got to the point to where they were a B-rated company. They had promised out more that they could actually pay for. So they had to liquidate. And they moved a large portion of their financials, so they no longer do the insurance side of it, over to other companies that actually assumed those and offered the same thing, because you're grandfathered into the contract that you purchase when you initially get your policy. So it's pretty powerful. And I feel much more secure having my money inside like a whole life insurance company, because they're the ones that are holding all the money rather than even having any inside my bank. Like if you look at my bank, you'll be like, okay, this guy is like, he's broke, right? Because it's like there's not much there. Like I don't want to leave money there. I want to leverage it and have it in movement as much as possible. And I know you guys know all about that.
Yeah, it can be frustrating from the lending perspective at times, because they're like, whoa, what's your liquidity? Oh, we're not going to take this account into consideration. We're not going to do this. Oh, we don't look at your assets when it comes to real estate and that stuff. And I'm like, I'm rich on paper, I think. I'm like, I need to somehow relay this information over to you, which ultimately, if you needed to show certain liquidity, you can pull money out of your policy, slap in your bank account for a few days, send them over the statement, make it work that way.
Definitely.
All of it.
And we're getting kind of close to another asset that we could even talk to also. Like if you're in a business and you don't really have a lot of cash heavy, or maybe you carry a lot, and then there's certain times that you put money back into your business, there's not a lot there. And if you need to access more or have a loan, you can even do this personally. You can open up a really large life insurance policy on yourself and then collateralize that against the loan that you're taking with your bank. So now instead of having no money at all, or maybe there's an investment property that's coming up, and you're an individual, now you open up a $2 million life policy and you take it to your bank, and you have the bank sign off for the ownership of that policy. So if anything happens to you, now the bank's getting paid, right? So they're using all of that and the cash value that comes with it. But now they can collateralize it, and you can receive money for having that exchange to put inside your investment until you pay back that and get the policy back.
Bruh.
So back it up.
What?
Hold on.
Wait, what's that like? Whatever.
Yeah, sure.
It's called a collateral assignment.
I did not know you could do that.
Yes.
So they can look at, hey, your death benefit is $2 million, even if you have all of your cash value out. So I'm going to use my exact example so I can hear this from you. We have about $200,000 inside of a whole life policy right now. It's under my wife, and we're going to open one up for myself pretty soon here too. We just wanted to make sure financially we could fund both the way that we wanted to. I could take that and make the owner of that be the bank, and they can cross collateralize that. Would they lend up to that $2 million value that they know they would get paid back on, or?
Yeah, so that is, well, it's not really a caveat, but since we're educating each other now, it's like they're not going to loan you what the death benefit is, because they're trying to use money, right? They're trying to figure out where the money is going to come from, especially if it's like a cash flowing account. Like an index universal life policy are very powerful on this stance, because the index universal life policies, you're tied to the value of an index. So you're doing like the S&P, so they know they're making money with the account. Right. So the bank is now giving money out at a leverage. They're still charging you an interest on that. Right. So they're still getting paid on the interest side of the loan, but they're now seeing you have enough assets and enough collateral that if something ever happened and you're able to default on your payments, that they have now a life insurance policy on you that they'll be able to receive, tenfold of whatever they gave you. Right. So the amount that you receive from that policy will be different depending on the relationship that you have with that bank. Now, we also work with companies that find those banks for you. Like if you have a horrible relationship with your bank, like you pay a bunch of fees and you're always drafting out late, and like you don't like their credit card, all this other stuff. We have companies specifically that we work with that find that right bank connection with you, that will allow you to use that and collateralize it. But again, that's like another completely like separate podcast.
We're gonna have like 5 different ones just coming out of this very short conversation we've had.
Holy smokes. Yeah. I'm like, we need to extend this another hour because I have so much I want to unpack with all of that. What are you seeing on average banks, in that type of situation, typically lending against? Do you see it being 10% of whatever the death benefit is? Do you see it being half of what the death benefit is? What does that usually look like? We've
seen anywhere from 10% up to 30%. Of what it is. And remember, it's something that they're banking on long-term, no pun intended. So typically they're not giving you the full value of the account. So it's definitely going to be in your best interest to pay off the interest on your loan, because while it's sitting there at the bank, it's continuously compounding and earning interest.
Yeah.
It's just continuously growing. You don't have access to it, which could be a good thing in this fact. So you've got a loan that's now great, gaining you assets over here. You're paying off that loan with the bank if you had to do it with the collateral to get your bank through or get your loan through the bank. But that policy that you signed off a portion of it as collateral is now continuously growing and working for you in the background.
Is there a third party that would facilitate this? Because like, what if they became bullies and they're like, no, you can't have this back? Like, is there?
Well, you as an individual can always go and open another policy.
Yeah.
So you can always go and open a different policy if you're like, I'm going to default on this. The bank is going to own it. Even though the bank now has financial steward over you, so they can keep that policy. It's not like Walmart that got in trouble last year. They opened up a bunch of policies on their janitorial executive staff, and they left and they started working for different companies, and Walmart kept the policies. So they were just making and racking in the money, and then they got in trouble because they no longer had financial steward over the individuals that they were covering. So the banks have a financial steward over you because you defaulted on a loan, so they're going to own that. However, it doesn't stop you from going and getting another policy on yourself.
Oh, okay. That makes sense. Okay. Mm-hmm. Just real quick, because again, I feel people's brains are like busting right now. Abel Liz Macias asked, can we actually start a policy with a business credit card? So could they use a business, let's say they have a 0-interest business credit card, which is very common the first 6 or 12 months. Well, what do you see in that, David?
So very few, if any, will actually accept like a credit card to continue. Like you can begin a policy with a card, but very few will allow you to continue it. Because the danger is like you're going to max the card out, the premiums are going to stop, and now it's going to lapse.
Yeah.
Mm-hmm. So you want to make sure that you're funding it at a rate that you can continue and it's comfortable for you. Now, you can always do what happens to me. I started off with a really small one, like the grandmother one, because I was like, okay, can I continue this? Does this actually work kind of stuff? So had it over 10 years, it obviously works. So then the second one I did was a little bit bigger. The third one, I have 5 of them. The third one I got was a lot larger. That's the one I used for my hard money lending. But each one serves a purpose. The other 2 are just for my wife and I. So if we pass, my kids will be able to continue this and be able to open up their own policies and start their own investment careers. But it's really important to make sure that you're not just like, for example, if you came and asked me if you could take a HELOC out and put this money into a policy like this, legally, I cannot tell you to do that. Because your HELOC, if something happens, you default on it, now you're losing your home and you're losing your policy.
Yep.
That makes sense. Okay.
Yeah.
So I won't tell you that you can ask for advance on your HELOC and you can ask for advance on your business card, but that's up to you, and you need to make that decision if it's worthwhile.
I'm not licensed. You can do whatever the hell you want to do. You can go to plastique.com and convert your credit cards into cash. There's a 2.9% processing fee plus 30 cents per transaction. However, if you're in a pinch and you need to make it happen, but make sure you have a plan to pay off that credit card. You still need financial responsibility.
I love that you just said that. I was going to go there.
Really?
Yeah, I really was.
I
was like, look, we're talking about responsible policy havers.
Yes.
Stephen is responsible. I feel I'm responsible. David's definitely responsible. If you're somebody who needs to first learn how to manage your money, I would recommend first taking the baby steps to do all that. And why did I say baby steps? Because as much as we talk shit about Dave Ramsey,
that is where you have to be.
That is your foundation. It should be your fundamentals. Like, do you pay your bills? Yeah. Like those things matter. So yes, there's actually a premium that you have to pay annually or quarterly, depending on how you've set up your policy. And if you can't cover that premium based on what kind of the amount of policy you're taking, then, put the brakes on. Maybe you need to learn some financial fundamentals first before you go that route. But at the end of the day, if you are somebody who generally runs your household in a surplus, then I think you'll be okay.
It's as simple as that. If you make more money than what you're spending, then you're probably going to be in a good place. If you got a 450 credit score and $20,000 of credit card debt, let's get our shit together first. And then let's talk about how to maximize from there. We got to create some good habits to begin with.
Especially if you're if you're still like drowning in debt, I can't tell you the power of having like a whole life policy put together. If you're already making $500, $600, $1,000 payments into credit cards, instead, you might as well be leveraging it. Put it inside a policy that you're paying, pull the money out to pay your minimums. And as that policy continues to grow, it will outpace those cards and continuously start drawing them down. So like there's so many things that we can leverage and even talking about. I know that we only have like a few minutes, but I wanted to answer this question here. It says, can I use my policy I have issued with my current employer? Any way to leverage what I've been paid into for the last 3 years? So the policy that you have with your employer is not the correct structure of what we're talking about today. So they're really just offering a base insurance policy, and it probably is heavily based on accidental death and dismemberment, because that's the cheapest that actually is around. Now, when you leave your employer, that policy might also stay with your employer, which means you may not be able to take it with you. So I doubt if any employers will have a cash value on you unless you're an executive. If you have an executive bonus plan, then yes, that policy will be portable. You'll be able to take it wherever you are. Or go, as well as like a key person policy. But like so many things that we could go in directions, even while you guys were talking, I was like, man, we could go this way now, but
I know.
I'll kind of stop the point. But I just want to say on behalf of your listeners, I think it's really, really great to know what you know and know what you don't know, and definitely know those that know what you don't know so you can learn it fast. But you guys have a lot of value with you, as well as, because I'm learning from this as well. And that's how you can tell a powerful podcast. Whenever it's not just the listeners who are learning, but each other is learning facts as they spend time with one another, because that's an asset that we can never get back.
Well, that's why every Wednesday at 1 p.m. Arizona time, we have the Explain It podcast to bring value to all of the listeners and bring awesome guests on like you, David.
Absolutely. We love attracting the people who are experts in their space, who can actually speak eloquently and intelligently and simply with the people here listening. Because our goal, at least Stephen and I, we carry those values that we do not gatekeep. We want everybody who absolutely has the will and ambition to learn everything they possibly can to advance their family's life. And that includes financial independence. That includes what real estate can do for them and what life insurance can do for them.
Yeah,
so for sure.
I do have a personal question I'd love to ask you, because this actually came up from me yesterday from a friend that reached out to me, and I wasn't familiar and I didn't do any research too much on it as well. But this is a high net worth friend of mine. And that individual said, hey, I'm being pushed to do this whole life policy. And immediately my first reaction is yes. But she said, hey, it's a 412E. Is there a difference between a 412E and the way that we're structuring these whole life policies?
Yes, definitely. And they're structured specifically on her situation. So like those, you definitely want to have a second opinion on. So like have two individual, if not three, different ones that you can combine and look in differences between each one. Because that, like the first thing that you said is she's being pushed. That should never happen, right? If you feel like you're being pushed into something, something's amiss, right? Like ask more questions, get to know like why you're being pushed so stringently, because there are a lot of ways that you can end up going. Now, if someone is actually talking about different benefits of different accounts and now you feel like you're more in control, definitely, that's where the power is. So I would love if you like provide my information to her, so at least we can talk over the phone and I can lead her through like illustrations she's received. So she kind of looks and can find the pitfalls of the 411s. But there are things that she needs to look for. And like I said, there's probably another podcast.
Yeah.
That's awesome. Well, David, I'll definitely get your info over to Stephen to help his friend. But absolutely. And actually, that's what's really cool. And I extend this out to anybody out there. If you guys do have more life insurance questions, if you do need more consultative effort, definitely would love for you guys to go to Secure Your Money First, because it's just the concept of this. But after you put in your information, then you can actually go and check out if David has availability for him to schedule a review with you, so that we can take it from there. So if you have more questions about what you can do with life insurance, what you can do and all the different products, right? Stephen just brought up one which is different than what we've been talking about. Right. And so there's just so much available out there, and you need an expert in your corner to kind of give you that advice.
Perfect. Guys, thank you so much for having me on. I appreciate it. This is a lot of fun.
Yeah. Well, we're not quite done yet. We have 5 more minutes, if that's okay.
Yeah, absolutely.
Okay. So I had some accidental is separate. Main policy is fine. Oh, she's the one that asked about the employer thing.
Perfect.
Would you like to speak more about the policy? What would like to speak more about the policy and Infinite? Oh, okay. Wonderful. So Denise Devereaux, which I hope I said your last name right. Go to secureyourmoneyfirst.com. And that's how you can sign up to see if you could talk to David. David's a part of my team. Again, I got so excited about all the possibilities of life insurance that I literally took less than a week and got my license. I know that there were some folks asking also about getting your license. Same thing. Go to that website. Let us know that that's the goal that you're trying to achieve, and then we can help you get through that process. So
one of the easiest businesses to start, honestly, is getting your life license. Just starting from there. Just like I did like 20 years ago. I remember starting it at Aflac, kind of going people and doing the supplemental insurance and thinking, man, these guys actually need insurance. And I couldn't do it. So definitely it'd be a joy to show you more about the industry, but also to answer your question. If you don't know by now, I really geek out of those really hard situations. So definitely I'd love to hear them. The great thing about going to secureyourmoneyfirst.com is that you get to hear a recap today. If you're like, man, like this, I caught a little bit, but I feel like I need like a recap, you'll be able to hear a conversation between us to kind of go through and explain them, and also a direct link to set up an appointment so that we can talk more about your situation.
Yeah. Okay. This one was a good one for Maritza, which I didn't bring up here.
I did this, Maritza.
Yeah. Can you buy a policy with a retirement account without paying taxes?
You can avoid something that's called the excise penalty tax, but you can't avoid paying taxes. Unfortunately, like Uncle Sam is going to get you one way or the other, but you can control when and also how much. Like, for example, with retirement accounts, if you're not currently doing backdoor Roth conversions, we definitely need to talk. We are in the lowest tax brackets that probably we'll see in our lifetime. I mean, I know who's president and kind of going in, so I don't know what's coming up. But if we're now converting, like take a page out of Peter Thiel's playbook, the co-founder of PayPal. Mm-hmm. He's got $5 billion inside his Roth IRA account. So how did he do that with a 7,000 maximum every year, or 6,000 depending on your age? He didn't survive 2 or 3 lifetimes to make that happen. He simply was taking old retirement accounts that were still qualified and he was turning them unqualified, meaning he no longer had to pay taxes on those. And he was appreciating all of that growth, having it grow tax free. So definitely there are strategic plan rollouts that you can do before you take even a pension payment to start to leverage what's called a 0% tax bracket. There's even a book written just like that. It's like the 0% tax bracket. So try to read it. It's super quick. It's kind of wordy in some spots, but try to understand like when you don't have to actually pay income taxes for the rest of your life unless you don't do something now. Right. So if you're within that fractional decade between like 10 to 5 years from retirement, we need to talk. We need to start rolling that qualified taxable money into tax-free entities so you can get it to grow that way and start pulling that out and at least mirroring or managing the money that you have coming in that's taxable and non-taxable. But this is kind of a little step away from the insurance and infinite banking style of policies. So again, we can talk about that later in another podcast. But if you have questions on those, and if you have a term policy that's been written before 2022, we need to talk. The Jobs and Secures Act had a major impact on the pricing, so you're probably paying too much right now. But I could talk about this for a while, like I said. But
guys,
what
if you can't tell, David knows his shit. Sorry, I had to say it.
What people don't know really can hurt them.
Yeah, really. That is true. What people don't know really can hurt them. I love that. Okay. She let's do it. Come on, Denise. Come. The water's warm. We're ready for you. So,
the grass is greener.
Yeah. It's an and versus an or, right?
Mm-hmm.
Like my primary skill set is still on the real estate side of things. And this is sort of like a tangent opportunity for me, just because there's just so many ways of overlaying the one strategy against the other. And it would be foolish of me, just as you've done, to not take advantage of it and maximize it in every way possible. So you guys remember to go to secureyourmoneyfirst.com to get some time with David and see if maybe you want to get your license or you want to get life insurance or talk about those other products that he also has available, especially if you're nearing that retirement age, as he said, that those 10 to 15 years before retirement age. So I've had so many people saying, thank you so much for this podcast. That's so amazing. I love it. We can't wait to have you back. I mean,
Seriously.
yeah.
Part two, we'll get a little bit more in the weeds, guys. We'll start breaking some of these strategies down. We'll talk about the IULs versus whole life versus the 412E versus this or that. We'll talk about all those types of things. So this will be coming up soon.
Yeah, for sure. Well, guys, thank you so much for being here with us on the Explain It podcast. Stephen Hunt, Ingryd Hernandez, David Foxx. We are here for you once a week on Wednesdays, 1 p.m. to 2 p.m. Arizona time. And we'll catch you on the next one.
Awesome. Thank you.